or should be punished according to what they can control. So responsibility centers, you make responsibility center divisions, right? And their responsibilities, you allocate the responsibilities to those centers. For example, cost centers. So there are three kinds of responsibility center: cost centers, profit center, and investment centers. So cost centers, segment whose managers has control over cost but not over revenues on future funds. So they are hired to control the cost. Basically, they are hired to perform control function of budgeting, and they want to see that whether we are exceeding our budget limits or not. If we are exceeding, then they put restrictions on further fundings. They are not responsible to generate revenues or making decisions for investments. So they should be judged according to their role as a cost center. If they restricted the cost, or if they decrease the cost, they manage to decrease the cost, then they would be rewarded, right? So they, because revenues and investment is not in their control, so whether company sale are increasing or not, they should be given bonus based on cost center. Profit center, whose responsibility is to generate profits. So generate profits. What is the profit formula? Revenue minus cost. So they have control over revenue and control over cost as well, right? But not the investment. So if profit happens, so where you are going to invest those profit, that is not your jurisdiction. So your responsibility is just to increase or find a ways to increase the revenues, decreasing the cost, and by doing that, you are increasing the profit. You are given bonuses based on increase in profits, right? And now investment centers. So those who have control over all those cost, revenue, and investment. So these are normally the headquarters. So we talked about we should replace this furniture, we should replace the fixtures, we should move our building, right? Where we should invest, whether we invest in buildings, land and stock markets, expand our business, which business, right? Should we change our product line? What should we do? Should we go for vertical integration or horizontal integration, right? So these are their responsibilities. So they set the target. Okay, this year our profit target is that we should increase our profit growth by 10% or 2%. How they are going to do that? Okay, if we increase 10% sales, we decrease our cost by 2%, then our overall effect going to be that we will be increasing our profit to 2%, right? So, and then by increased profit means we can pay off our dividends, and we can pay off renovating our old building. So that is also investment. So they make some kind of strategies over there, and then they spread those strategies or policies to overall centers, profit centers, and cost centers, right? Okay, now here comes the real, you can say, real talk of this chapter. Learning objective 1, which is compute ROI, return on investment, and show how changes in sales expenses and they are affecting the ROI. So remember that disadvantage that we talked about, that sometimes decentralizations act as a barrier to the innovation. So we'll talk about here how it will happen. But remember that question, and then when we do some calculation, then I would be telling you after a couple of slides that how decentralization, who has a lot of benefits, it can act as a barrier for innovation, right? Let's just talk about first, what is the formula for ROI? It is net operating income, or in finance we call this EBIT. Remember, this is operating income. Business operation is to sell and to buy raw material, convert it into finished goods and sell it. So that is the business operations, right? So interest is not in your hand. You cannot control the interest, right? It's a fixed amount you need to pay. So that's why interest is not included. It's not less. It is not less from the net operating income. Similarly, with the taxes are also not. It's not in your hands. Who decides the taxation? Government. It's not in your hands. So that's why we do not include the taxes and the effect of taxes and interest rate. So that's why we call this net operating income, which is EBIT, earning or income before interest and taxes, divided by average operating assets. So those assets who are productive assets, right? All those assets, see, cash, accounts receivable, inventory, plant equipment, and other productive assets. So there are some assets who are non-productive. For example, in the case of like goodwill, I would say, because goodwill is when you purchase some other company, so the extra amount you pay on the top of their real valuation, we call this goodwill. That is a brand valuation that we pay because of the reputation. So that reputation doesn't help us to generate new income because now we control that company. So that is a non-productive assets, okay? But here, all those assets that we use to generate our sales, right? This is called the operating assets. So average operating assets is going to be beginning operating assets plus ending operating assets divided by 2, average. So normally it would be given to you. If not given to you, then how you can calculate average means beginning at the start or previous year operating assets plus this year operating assets. You add it, you divide it by 2. So net value versus the gross cost. So gross cost is going to be here and net value is going to be after the accumulation of the depreciation. So most companies, they use net book value of the depreciable assets to calculate average operating assets. So here, while calculating the operating assets, so you see plant and equipment. So what values we should take here? We should take the values after depreciation, right? So, okay, so we were talking about the ROI, the two-step ROI. So let me just explain that. So from here, ROI is equal to margin into turnover, right? So where this formula came from. So we know that ROI is equal to net operating income. I think I should write down some abbreviations. So net operating income divided by average assets. Let me just write it down, the A assets, assets. So can we expand, or I could just write down total assets. Can we expand this formula? Just multiply sales with sales. Net operating income divided by total assets, right? So if we see that here, we can rearrange this formula as the net. Can I write it down here? No. So let me just, so we can write it down here as well. So net operating income divided by sales, multiplied by sales divided by total assets. So in this case, the formula remains the same. Net income divided by total assets. Sales cancel, formula remains the same. So we just multiply accordingly. So net income divided by sales is going to be profit margin. Sales divided by Total assets is going to be, the name is turnover, asset turnover, right? So this is how this two-step ROI is calculated. We do have three-step as well, but that's not the requirement here. So I'm going to just skip that. So this is also called two-step. Two-step ROI formula. Okay, let's go back to slides where we can just see that. So we know that ROI is equal to net operating income divided by total assets, total operating assets, or average operating assets. So margin is equal to net operating assets over sales, NOI over sales, and sales over total average total operating assets. So if you multiply these two, so sales cancels, answer going to be the same. But the question is, why there's a need to divide this formula into two parts, margin and turnover? Let's just talk about that. So example is, a Regal company reports the following income. We have net operating income, we have average operating assets, we have sales, we have operating expenses. So can we calculate the ROI? Yes, we can calculate the ROI through net operating income divided by average assets, or we can say that net operating income divided by sales and and sales divided by average operating assets. So there is no need of operating expenses. So this is the extra amount here. We just delete that. So what is the ROI here? ROI here is 15%, right? So if you calculate ROI, 330,000 divided by 200,000, answer going to be the same, 15%, right? This is two-step ROI and one-step ROI. Both results are same, 15%, 15%. So why there is a need of two-step ROI? It's because we want to know that ROI means return on investment, right? So how much you earn on your investments, right? So this ROI, when we divide it into two parts, margin and turnover, then it helps us to find out the efficiency. Efficiency is that 6% we have generated return from sales, right? 6% from ROI we have generated sales, and we have used 2.5 times total assets, total average operating assets to generate sales. What does it mean? It means our sales are 2.5 times of our assets, right? It means from small quantity of assets, we generated 2.5 times sales, and from that sales, we generated 6% net operating income.